just figure out what your goals are, figure out what you want. Do you really want to be managing, maintenance technicians, leasing agents? It's really an operating company. So do you really want to take on that, or do you just want to partner with someone who's experienced like Sam, or whoever the sponsor is, and have your money work for you, and do whatever you're doing as a hobby or a passion or whatever. Just really figure out what you want to do.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Anthony Scandariato is the co-founder of Red Knight Properties. Red Knight currently has over $100 million in assets under management, 750 units in 4 different states on the East Coast. Anthony, welcome to the show.
It's cool to be back on, Sam. Really appreciate you having me on again.
Pleasure's mine. You came on episode number 72, so the show is just getting kicked off there. I think if you want to go back and listen to Anthony's story, we won't spend a lot of time on today's show kind of hearing his previous, story that he shared with us on episode 72. That was on February 9th of 2021. By the time this goes live, this will probably somewhere close to June of 2022. So that's almost 16 months later. In case somebody, though, they didn't get the chance to listen to it, can you give us a 90-second synopsis where you started, where you are now, how you got there?
Yeah, quickly. As Sam said, I'm one of the co-founders of Red Knight Properties. We're a privately held boutique mixed-use and multifamily investment management company for real estate, as well as a property management team. As Sam said, we have about $100 million under management. I think when I came on Sam's show, we were more like 60 million. So basically doubled from that, year time period. We did quite a bit of deals in 2021 and over 750 units. I think we only had maybe 400 units, give or take, in 3 different states. Now we're in 4 different states. So pretty exciting. I think we were just closing in our first Southeast state of this great state of Florida. And we're actually starting to sell some assets now, kind of given the state of, where the market is and how quickly, especially the state of Florida, has really grown from, so many different standpoints. And so we're starting to sell some of our assets that we didn't even consider sell. We weren't even considering selling for another 3 to 4 years from now. We're actually selling early. So happy to talk about why we're starting to sell early and, kind of deviating from our business plan a little bit.
Love to hear that. The floor is yours. Why are you selling early?
So I started my company 2018 and, started out, we can go back to the other episode and listen, but since basically 2018 acquired, almost 1,000 units at this point. And, we're value add investors. We come in and find operational inefficiencies from a management standpoint, and mostly from a management standpoint. We're buying assets from motivated sellers, long-term owners, when we're investing capex that hasn't been put to life in 10 to 15 years, and we're really bumping the rents up. And for us to get a 25% rent bump within the year, where we're investing the dollars necessary in order to get that bump. We're not just going in and raising the rents like a lot of other operators. We just think, at this point in the cycle, and, this is releasing in kind of like mid Q2 of 2022, when interest rates are on the rise, inflation's still going to be carried out, in my opinion, for the next couple of years. Probably not going to be as elevated as it was 2021. But it's still going to be a problem. Moving forward long term. Depends what the Fed, decides to do. Probably by the time this is released, they'll probably raise another 0.5 point. But with all those, macroeconomic, situations, rates aren't going to go down. Inflation is going to stay pretty high, in my opinion, which means rents are still going to go up. We just think the value, it's almost like we front loaded a lot of the appreciation over the past couple of years. And I feel like we're not going to just see that huge increase and spike in value that we saw in the, once the Fed basically did their QE and rates were at near zero for a couple of years. It's just not going to, the values are going to start to slow down. I'm not saying they're going to crash. They're going to slow down. And obviously in the commercial real estate, it's all driven on NOI, right? So, as quickly as you can get rents up for us, and we see the value, there's a property in Florida we're selling for double what we paid for it a year ago. And, our projections weren't even assuming that 5 years from now. So we're looking at the returns and we're like, well, if we can provide people basically double their money in a year, and then we can do some tax deferred strategies, reinvest the capital, if they decide to come back, reinvest the capital into another opportunity that's maybe not in as hot of a market as Florida, because there's a lot of capital there. We were talking about this on our show, which I'm planning to release as well. Sam was on my show, Discovering Multifamily. And we were just talking about some of the pivots he's been making to his business. We're doing very similarly, but we're sticking with our asset class, multifamily. We're going into other markets now. We're looking at Midwest markets that haven't really been tapped as much as the Southeast is been lately. Even where I'm based in the Northeast, it's kind of always been a little saturated. So we're pivoting just because where all the money's flowing, we kind of want to come in early, and then you kind of got to know when it's right to get out. And as of right now, we could refinance. Everybody can get the money back. We can roll that into another property. Great burst strategy for commercial real estate. And I think we touched on that in the previous episode. You just got to do your numbers and see what makes sense. And, really just analyze all the risks in the economy and really make an informed and educated decision. Might not be the best decision, but at least, you want to just have an opinion, and you want to be able to come up with some logic behind, okay, why are we selling early? Why are we selling 4 years early? Well, the reason is X, Y, Z. And, so it's very interesting, and you're seeing it in the market as well, I'm sure. So, we'll see what happens, but yeah, a lot of other operators I've talked to are experiencing the same type of feelings, starting to sell assets early, and they're doing well on them. So,
yeah, and there's never a bad time to execute the entirety of the business plan in a shorter time frame. It's like, oh, great, lucky us. We said 5 years, and now we're going to do it in one. I mean, that's okay. That's quite okay. I'm really curious when you think about the inflation to rent price ratio, right? Like we've seen inflation, published 7-ish%. And then we've seen rents, again, it's a very localized number, but let's just use something arbitrary and say it's 15% on a national average, right? I don't know what it is on a national average, but it's greater than what inflation has been. At some point, do you feel like that is going to swap like positions there where the rents are not keeping up with where inflation is going just because people don't have the income to support it at some point? Do you think that's going to happen?
You're right. It depends upon wage growth at the end of the day. And if that's going to keep up with CPI, you really should be looking at CPI. The Fed likes to quote PCE. So PCE, they don't have really rent, like the real rent figures in that number. So I think inflation is higher than what they're representing, to be honest with you. And I know a lot of other people do as well. At some point, yes, it's good. We like to look in markets where rent is maybe 25 to 33% on the high end of their wages, of their income. Right. So if the wage inflation is not keeping up with rent or just regular CPI inflation, it's going to be a problem. There's still a supply and demand issue. Over the past couple of years, I think the level of new homes and also new apartments are down 50%. And it's only going to get worse because now with rates rising, there's going to be a lot of builders that go belly up. Unfortunately, there's going to be a lot of customers, I think, on the single family side pulling out of deals. On the apartment side, it's getting harder to build, because costs are just higher. So they're going to have to pass that on to the consumer. I specialize in the Class C space. So, you can't even, we're trying to buy deals below replacement costs in the first place. It's going to be a problem. Like I said, I keep going back to, I think we front loaded a lot of the appreciation. We're not going to see 20% year over year. It's stupid. And I get opportunities from other sponsors who still believe that's going to happen just based on Sure, it might. Who knows? If you're buying in the state of Florida, maybe it's going to happen. But I don't want to see a projection where, on a Class C property where you're projecting $2,000 a month for a 1-bedroom apartment, even if you renovate it. It just something about that does in a suburban area. It just doesn't seem right to me. Because you really, like you said, Sam, you got to look at the employment drivers, and it's all local. The employment drivers in the area. Where are the jobs? What type of wages are they paying? Is that industry experiencing, wage inflation's across the board, in my opinion. Unemployment's at a all-time low. I actually think the unemployment rate's probably in the short term going to go down even further. But then probably by the end of the year, go back up a couple points. We'll see. So, it's a very interesting conundrum. The good thing about the commercial real estate world is, if the rents still keep going up, let's say 3 to 4% a year, your NOI keeps going up. If interest rates rise, theoretically, it's not always 1-for-1, but cap rates, rise a little bit, maybe 10 basis points for every 100 basis points in interest rate move, which is kind of weird because it's not a 1-to-1 correlation. And again, there's still a lot of money out there that was on the sidelines for 2 years, chasing, multifamily, industrial, self-storage, those 3 hot asset classes. They're concentrated in different areas now, like I said, in the South, in my opinion. So there's still a lot of cheap money out there, a lot of balance sheet lenders, a lot of bridge debt I'm seeing. I'm a little nervous for some of the sponsors who took on very high leverage bridge debt, and they think they're going to get out of it in 2 years, and they're maybe slow on their business plan.
Right.
And when they go to refi, they got to do a capital call because the value is not there. So I'm a little concerned with that. But for sponsors that have been experienced around there, that's a good opportunity for them to start picking up some of those quote unquote distressed properties. But I still don't think we're going to see that for a couple of years.
Right. No, couldn't agree more. Talk to us about your deal that you are exiting. You guys said
Sure.
you're rolling that, or at least some of the proceeds of that, into another deal. Are you doing one large syndicate or one large 1031, with your investors, and they're just going into the next deal, or what's the process like on that?
Yeah. So sale hasn't been completed. Well, by the time this is released, it'll probably be completed. But as a sponsor, and just some piece of advice, it's very difficult to do a 1031 in a syndication. Very difficult in my experience. If you don't have a tick set up from the beginning, it's going to be very challenging for you to do it moving forward. So what we're doing is we are just as if we sold the building and we were buying nothing else. However, we were fortunate to find another opportunity, and we do cost segregation studies and the ability to pick up bonus depreciation. This is 2022, I think, is the last year for 100% bonus depreciation. So whatever capital gain, my investors, including myself, because I invest as well, have to pay, hopefully if they choose to reinvest, most of it or all of it can be offset by another reinvestment. So it's not a 1031 exchange, but there still is some tax benefits and deferrals, because you still have to pay it at some point. It's not avoidance. Could be worked out. So that's what we're currently working on. But yeah, it's tough to do a 1031. If you don't have it set up from the beginning in the tech.
When you say set up from the beginning, can you explain that? Do you mean set up in the initial investment as a tick? So you're saying if you're going a tenant, which to those who are listening, a tenant in common deal, you're going tenant in common, then you go to your 1031 intermediary, you roll the money into the intermediary, and then you go into the next deal as a tenant in common. Is that what you're saying?
Correct. And it becomes complicated, if you don't have a tenant in common structure set up from the beginning, because you can have one investor that just wants out,
right?
Just wants their money back, and it happens.
Right.
We've done deals where we've refinanced, we give everybody the money back, and maybe one or two people, I need the money because I'm buying a house, or I'm doing this, I'm going on vacation. The 1031 in the tick, if we set it up from the beginning, they would actually all just move forward, because it's not set up initially. One person, and if everybody was on board except one or two people, it blows up the tick.
There's a way around that. There is a way around that, because I was just involved in a deal and I was that investor. that said I didn't want to roll over. One, because I wasn't in love with the next opportunity. And then secondly, because I'd invested with my IRA fund. So it didn't really matter to me if we were 10, and then they didn't set it up as a 1031 in the beginning. So I'm like, one, I don't like your deal, the second deal, and two, like I gain nothing by, this is a self-directed IRA. So I gain nothing by, 1031ing this. So I want out, right? So I was that pain in the neck investor. Sorry, Anthony. But there was a way around it. And I don't know what they did. Because you could have, in the deal, they found a way, but it was paperwork heavy, to your point.
Sure.
It was paperwork heavy, and there was new LLCs created, and just a lot of,
it's complicated.
Yeah.
I would say neither of us are tax advisors or experts, so we're not the right people.
No, I guess you're absolutely right. No, don't take anything I say here as tax or legal advice. That's for sure. But just to note that there is a way around it. It's just messy. So sure. To your point, let's avoid all the mess we can get. 2018 to now, what have you seen change on the capital raising side of things? And are you guys doing anything differently than you were 4 years ago?
Yeah, I think it's streamlined. More. It's becoming easier to raise capital. And as we were talking, there's a lot of money still out there in the system. And also we cater to individual investors. So we're usually talking to mostly high net worth individuals, putting in 50,000 or 100,000 into a deal and looking for income and also, equity upside at the sale or the refi. So, it's really grown upon itself. I think once you've been around, and I've been in the industry since 2014. So, I have, it's not 2018. I worked for somebody else. But once you kind of develop a reputation and you start, producing case studies, you start selling, you start refining, whatever the case may be, you'll be able to show those returns into, to find more investors and more partners. So it becomes easier in that sense. And your network starts to grow. Obviously, we both have podcasts, so our network. Both of our networks have grown from that. I think you just have to have a system in place. We have an investor portal. We have software that kind of manages relationships, CRM, and it kind of grown upon itself. Most of our new investors come from existing investor referrals. There's always the one-off that found us on LinkedIn or on our podcast. But it's probably similar to you, probably 70% are referrals. Yeah.
That's awesome. Yeah. And that's so true. So true. Yeah. You'll get one-offs, but a lot of it is just, it's a very, very referral based system. If someone were getting in the business today and they're launching out and they want to invest in multifamily, what is one piece of advice you would give them?
Just figure out if you really want to be active or if you want to be passive. Figure out what you want, because they're both very different. I started out active. I mean, I'm obviously still active. My ultimate goal, and we were talking about this on your show, Sam, is, I'm still young, and so are you, is to become fully, limited partner and fully passive at some point. So just figure out what your goals are. Figure out what you want. Do you really want to be managing, maintenance technicians, leasing agents? It's really an operating company. So do you really want to take on that, or do you just want to partner with someone who's experienced like Sam, or whoever the sponsor is, and have your money work for you, and do whatever you're doing as a hobby or a passion or whatever. Just really figure out what you want to do, because I have people who have come to me that want to be active, and then I start telling them how much work it is, and they're like, you know what? Let me just put my money in a deal, and then let's see how you do it. And then if I think it's a lot of work, then I'm not going to do it. Moving forward. So that's happened. I can't count on one hand. It's definitely multiple times that's happened.
Right. Yeah, that's so true. Absolutely so true. And it's a great point, because a lot of people want to get involved in real estate, then they get overwhelmed with the mechanics of it. Like, oh my gosh, there's so many terms. How do I do this? How do I do that? And then it becomes just kind of the confused mind says no, and they shut down. Like the easiest way and the best way, at least for me, the same as you, I think, is that become a passive investor. I mean, that's how I cut my teeth in this. Is I came in as a passive investor, and I learned through others while investing, and it was like, oh, okay, now I understand it. So that's an absolutely fantastic point. Anthony, thank you for coming on the show today. It's a pleasure to have you back. I've enjoyed our conversation, learned certainly a lot more about what you guys are doing, why you guys are exiting deals, where you kind of see the market going, and then also, how you guys are protecting yourselves. So
Sure.
certainly enjoyed that. Thanks for sharing your wisdom with us. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Sure. We have a website in my company's redknightproperties.com. So just go there. We have a free ebook, How to Leave Your 9 to 5 Through Investing in Real Estate. That will actually pop up. Just put in your name, your email. I can send that to you for free. All my contact information will be on there. Facebook, Instagram, Twitter, LinkedIn, either my name, Anthony Scandariato, or our company, Red Knight Properties, where, we're on everything. So
Absolutely. Anthony, thank you again for your time. Appreciate it.
all right, Sam, thank you.